Across Europe last week, equities were lower. We saw equities round about 1 to 2% lower in some of the more mature European economies, 3 to 4% in some of the weaker economies. It reflects the fact that we've had quite a good run in equities up until this point, so some profit taking unquestionably was due. But the ongoing question is, have we seen the top of the market for this year, or can we move higher? Certainly, as we record this on Monday morning, the opening session for the final quarter of the year, 1st of October, has started in good form. We've seen most of European markets opening much higher than they were forecast to be. That's despite the fact that the bank stress test in Spain was generally regarded as a satisfactory result, but without any sort of outstanding successes within Spain, and some question marks over what criteria was used to measure the stress test in Spain. But markets are moving higher, and I suspect reflects the fact that as we enter a new quarter, there has been a new allocation into the equity markets. I'm not picking out any discernible trend, so it looks to me as if it's across the board buying. Just looking around the world and what sort of things are going to impact on the fourth quarter, one growing concern has been what's going on in China. We're seeing manufacturing data coming out in China that continues to show that things are slowing up at the moment. Forecasts for GDP growth in China still hang around that 8% level. We've seen it down to 7.5%, but in fairness, a lot of the internal data that comes out does not support that level of growth. Indeed, if we take a look at the first chart here, this is the chart of the Chinese stock market. We've shown this before. We have seen a little bit of a spike up, and every now and then we are going to see hopes of stimulus coming back into the economy. They have got ample scope, of course, to stimulate the economy from here, and so markets rising, I think, more on stimulus hopes than anything coming out from the economic data at the moment. But China's stock market has been one of the worst performers for this year. If we were to look across the board, most markets are higher at this point than they were at the start of the year. China, as we can see, is well down, and it's really just very close to that 2,000 level, which I think will be psychologically important. If we come back to our own market here, the FTSE, and as I say, building on those gains, we are range bound. There's no question that the top end of the range this year, which is 5,950, has been hit twice now. We have shied away from it and coming back into the 5,750 region, but each time we do come down to these sort of lower end of the ranges, we can see higher highs building there. There is a feeling of some buying coming in, so I think the overall tone at the moment is it's hard to get too bearish on equities. Yes, lots of things to concern at the moment, but in the interim, as an asset class, it has its place in life, and certainly we're seeing some buying coming in at the low end of the range. So trying to break back above 5,800 as we speak. Now, one chart which we have mentioned in the last few sessions has been the development of the VIX. This is the Volatility Index. It was a notable trend that through July, August and September, which we would classify as the Draghi period, the period of the launch of the bond buying programme throughout Europe, one of the impacts of that is we've seen much lower levels of volatility creeping in. Indeed, through September, I saw some daily prints that were back to the levels last seen in 2006. But these things tend not to last for too long. We tend to find that things will occur that causes volatility to increase. And indeed, I'm starting to feel that we're seeing the first signs of life in volatility. Just in the last few sessions, we're starting to see some bigger moves, both to the up and downside at the moment. So I think, you know, we'll just watch this space with this one, but a spike back into the range, back into the normalised range of 20 on the VIX would start to create a more volatile environment for equities going forward. Now, in terms of some of the features in Europe, we do continue to keep an eye on these Spanish 10 years. They are an important indicator of the sense of what's the view around Europe at the moment. Where I think the honeymoon period for the bond buying programme has seemed to have faltered in the last few sessions relates to whether Spain is going to ask for the bailout, and indeed there have been some technical issues relating to the European Stability Mechanism, that's soon to be renamed the EFSF. It appears that Germany may have backtracked on some of the conversations that took place in June of this year at the summit in terms of how money going into the banks, how how it would get there and whether it would impact on some of the sovereign ratings. For some time, I think markets have assumed that Germany would concede on this point, but recent comments have suggested there may be some backtracking. So again, I will just keep close eye on that in the near distance. Just a few stocks to mention. This is Apple. Apple is becoming a bit of a concern for some of the US markets because of its sheer size relating to the S&P. So often when we do see markets down, it is often led by the fact that Apple is seeing some profit taking at the moment. Having peaked out at 700, it is coming down to around 667 at the moment. So it has had an impact, as I say, on sentiment over there. One of the stock that we have liked and continue to like is Google. It's moved pretty much in a straight line, as one can see from this chart, up to 754. We're just observing that in the very near term, the relative strength index on Google is very high at the moment. It's up at 82. So a sense that there may be a time for some short-term profit taking on Google. Still love the story in the longer term, but just be aware that it's looking strong on the relative strength charts. And finally here, just concentrated on the currency of the euro versus the dollar. We have seen some weakness there at the moment. Signs in America that consumer confidence is running higher than expected. We saw a print last week of 70 compared to 63 expected. So the data in the US going into the elections in the fourth quarter, and obviously some concern about what will happen with the US fiscal cliff later in this year, is starting to come into the press. But despite all of that, consumer confidence in the US seems to be holding up.